As we just teased coming into our final commercial break, because now we're not taking them anymore, there were two mystery men that we showed you before we tossed to the break. Well, let us reveal their faces. Now, while President Trump often takes aim at the Fed's Jerome Powell and the central bank for the market's recent steep declines, Peter Schiff says actually both parties will be the ones to blame when the recession he says we're about to see makes the financial crisis of 2008 look like the roaring 20s by comparison. Schiff is here. He's the author of The Real Crash. Euro Pacific Capital CEO Peter Schiff joins us. But in the spirit of fair and balance, the man in charge of the trading group at TD Ameritrade, Executive Vice President Stephen Quirk, says October's volatility, and especially what we're seeing now, in no way signals the end of the world. All right, Peter, to you first. Why are you blaming both President Trump and Jay Powell of the Fed?
Well, I'm blaming both political parties. I think that the Republicans are going to take the blame because it's going to blow up on their watch. But if you want to name names, you got to go back to Alan Greenspan. You know, he's the one that really wrote this playbook. Every time we had a bear market while Greenspan was, chairman of the Fed, he would quickly restart the party with cheap money. And so we set this process in motion, but it's not going to work anymore. We've done it too many times.
Why is President Trump to blame, and why is Jay Powell to blame?
No, they're going to get blamed because they're the fall guys. But the problem started long before Trump was elected. You know, he called this a big, fat, ugly bubble when he was running.
But he's the one now asking for rates to stay low. Are you saying that the Federal Reserve should not raise in December, Peter, or should it even, dare I say, cut rates?
Now, look, it should raise rates, but the market's going to collapse as a result. I mean, they just haven't figured this out yet. We have a gigantic bubble, and the point I wanted to make is this bear market is not going to end quickly like the ones since 1987. This is going to be a protracted bear like the one we had from 1966 to 1982. 16 years without a new high, and meanwhile the cost of living went up dramatically. The cost of living is going to rise even more dramatically during this secular bear market. And look, there's nothing that can be done to stop this. But unfortunately, you know, for America, I think the rhetoric of the Republicans and Trump, tax cuts are going to get blamed.
Hold on,
deregulation is going to get blamed. Yeah.
We are now heading to more session lows here. We are now down about 411 points. Steve Quirk, you have the benefit right now of the TD Ameritrade herd, and you can check in on that herd and see what they are or are not doing. You have a massive $1.3 trillion in assets over there. How is the herd behaving, and are you as bearish or worried as Peter is?
What I'll do is I'll give you a reflection, because thanks for having me. I think the value that I bring is telling you what our 11 million retail clients are doing. Last time I was on about 2 weeks ago, I told you they're quite contrarian as a group. So when we see sell-offs, typically we see stronger buying. We've noticed in the last 4 months that sentiment has really dialed back. In other words, the buys and sells are almost evenly balanced, and we're seeing more rotation into what I would call the cyclicals, the utilities, things that they think lower beta stocks that are going to protect them should we continue to see this down move. So I would say they're not optimistically saying this is going to bounce right back, but they're also not saying this is the end of the world.
Peter, corporate earnings for the S&P, we just saw them upgraded for this third quarter, that they look to be up about 25.2%. We've got a lot of big names coming out this week. Is there not the chance that some of these names could really engender positive feelings about it for investors? And I know that you are bearish on U.S., but you are not necessarily bearish elsewhere.
Well, you know, there is a lot of optimism about earnings, and unfortunately that's already priced into these stocks. But, you know, I think a lot of the earnings came from lower taxes, maybe about a third of it. But, you know, a lot of these earnings are going to go away during this recession, and especially as interest rates keep rising, because a lot of companies took on a lot of debt during the boom. Now they have to service that debt during the bust. Their revenues are going to go down. So earnings could collapse very quickly. And so stocks have got a long way to fall. The market is very overvalued. And I think there's so much complacency out there. You had record highs in sentiment, in consumer, investor sentiment, small business sentiment. Nobody expects the recession, right? But then when it hits, everybody is surprised. And this time, they're going to be even more surprised. And I think it's going to make the recession that much worse when it starts, based on how ill-prepared people are.
Guys, I need to just point out something. The 10-year yield, and I've been keeping my eye on it for the last 35 minutes. When we came into the show, we were at about 3.09%. It's dropped 2 basis points now to 3.07%. What does that mean? And I articulate this. I know it's on the lower ticker, but we've got a lot of folks in the car listening on XM 113 to us here on Fox Business. That means that there's fear in the market at the moment, and I'm pretty sure the VIX, indeed, yep, it is moving higher right now, pretty much at session highs. The fear coming in spurs a sort of a flight to quality, or a flight to a safe haven. But Steve, talk about things that Peter maybe doesn't see. You know, we got a decent GDP number just recently for the first print on third quarter. Our unemployment is low. Peter would say that the unemployment was low in 2007, right before that crash.
Yeah, I would say, you know, look, I think I'll give it to you through the eyes of our clients. What they're looking at is saying, you know, earnings are pretty good. Half the S&P has now reported. Quarter of them are going to report this week. Economy looks pretty good. Obviously, there are a lot of concerns with tariffs and some of the other things going on, but there's, you know, if you look at the volatility levels, today it's 26, 27. If I go back historically and look at moves like this, we'd be in the 30s. And I'm not saying that's a perfect indicator, but I think what our clients are trying to do is just assess whether this is, you know, an opportunity for them to maybe dip their feet back in the water and get some more exposure, or just to sit tight.
Okay, very quickly, Peter, what are you buying? What are you putting money in?
Well, first of all, earnings are always good at the beginning of bear markets, and you know the numbers always look good when the recession starts. Yes,
answer my question.
Look, gold. You talk about fear. Gold's not even up today. Gold stocks are on sale. That's where the sales are right now on the gold stocks. And look, a lot of the international value stocks that I've been buying, many stocks were up 10, 20% last week. A lot of people didn't notice that. But as this bear market is starting, people are shifting. They're relocating out of the momentum type stocks to the value defensive names.
Okay.
And that big shift is going to be out of U.S. stocks, which are the biggest bubble, into some of these undervalued foreign stocks and emerging markets. That's where the real buying opportunity is. I wonder how many retail investors are buying the emerging markets now, or buying gold stocks. I don't think many at all. And I think that's a great indicator that that's where you should be.